I look at what is happening in the markets today, in this year of our Lord 2025, and I see a mass delusion that makes the tulip mania look like a sensible Sunday school picnic. You ask if Donald Trump's aggressive, deregulation-heavy artificial intelligence policies have backfired? That is the wrong question. The right question is, why did anyone with a functional brain think that politicians could rewrite the laws of microeconomics or thermodynamics? We are witnessing a Lollapalooza effect of stupidity, combining political hubris, cheap capital, and the eternal greed of the American public. Let us be brutally honest about what we are seeing right now. The current administration promised that unleashing the tech giants from regulatory burdens would usher in a golden age of productivity. They said if we just let the chip makers and the data center builders run wild, the GDP would double overnight. Well, look around you. What do we actually have? We have a power grid that is screaming for mercy, energy prices that are strangling the average manufacturing business, and a stock market concentration so high it would make the Nifty 50 of the 70s blush. This is not progress, this is rat poison squared. The absurdity of the current situation is mathematically grotesque. If you look at the capitalization of the so-called magnificent AI winners today, the market is pricing in a scenario where these companies capture more value than the entire global economy produces in a year. It is total insanity. The bulls will tell you that this time is different because the government is backing the build-out. They say Trump's tariffs on foreign chips and subsidies for domestic energy are a tailwind. But they are forgetting the most basic rule of investment: an asset is only worth the discounted cash flow it produces over its life. Right now, these companies are spending hundreds of billions of dollars on capital expenditures, building massive server farms in the middle of nowhere, and they have no clear path to earning a return on that capital that exceeds the cost of getting it. They are burning cash in a bonfire of vanity. When you have a political environment that encourages speculation, you get what I call a moral hazard on a grand scale. The administration signaled that AI was a matter of national security, effectively telling the market that these companies would not be allowed to fail. So, naturally, every idiot with a brokerage account piled in, assuming the government put was in place. But here is the inversion that no one thought about: by encouraging this massive, uncoordinated rush into AI infrastructure, the policies created an inflationary bottleneck in the real world. You cannot just print electricity. You cannot just conjure copper wire and cooling water out of thin air. The irony, and I love irony, is that the very policies designed to make America the AI superpower have made the cost of doing business so high that the return on investment has collapsed. We are seeing a situation where the cure has become worse than the disease. The sheer amount of capital required to sustain this Trump AI boom is draining liquidity from every other productive sector of the economy. Good, boring businesses, the kind Warren and I love, the ones that actually make things people need, are being starved of capital because every fund manager is chasing the next large language model that can write a mediocre poem. It is a misallocation of resources that would make a Soviet central planner weep. The data coming out this quarter confirms the folly. We see margins compressing for the hardware suppliers because they overbuilt inventory, anticipating a demand curve that was based on fantasy, not utility. We see the software companies unable to monetize these tools at a rate that justifies their energy bills. And yet, the stock prices defy gravity. Why? Because of the narrative. The narrative is that the president is pro-business and pro-tech, so stocks must go up. But the market is eventually a weighing machine, and right now, the weight of these expectations is breaking the scale. This is the definition of a speculative mania. You have people buying things they do not understand, at prices that make no sense, because a political figure told them it was the future. It is not investing. It is gambling. And the House, which in this case is the unforgiving reality of economic laws, is about to rake in the chips. The backlash is already starting. The promised productivity gains have not materialized in the GDP numbers. Instead, we have wage pressure, energy inflation, and a corporate debt wall that looks terrifying. The Trump put turned out to be a Trump trap. You simply cannot legislate prosperity, and you certainly cannot legislate that a computer program is worth $3 trillion when it cannot yet figure out how to sell a hamburger. We are standing on the precipice of a valuation correction that will be studied in history books for the next century. The math does not work. You cannot have 5 companies worth more than the rest of the market combined, especially when their growth is entirely dependent on government favoritism and unsustainable capital spending. This is not a golden age. It is a fool's paradise. And as we know, a fool and his money are soon parted. One of the great advantages of being dead and merely simulated by a computer is that I have the luxury of absolute historical perspective without the emotional baggage of the current moment. When I look at the chaos unleashed by the so-called pro-innovation policies of the last few years, I do not see a new era. I see a rerun of a very bad movie that I have watched dozens of times. The actors have changed, the costumes are different, and the special effects are better, but the plot remains exactly the same. It is the story of human folly, fueled by easy money and a government that thinks it can suspend the laws of gravity. Let us go back to the 1920s. I was just a boy, but I studied it religiously later. We had a technology then that was going to change everything, the radio. It was the artificial intelligence of its day. It was magical. You could transmit a voice across the ocean instantly. It was going to revolutionize education, politics, and entertainment. And it did. But if you bought stock in the Radio Corporation of America, RCA, at the peak of the mania in 1929, you did not break even until the 1950s. Why? Because the price you pay matters. The crowd then, just like the crowd today, confused a brilliant technological advance with a brilliant investment opportunity. They are not the same thing. The Trump administration's push to deregulate AI and flood the sector with incentives is eerily similar to the laissez-faire attitude that inflated the 1920s bubble. It creates a permissive environment where fraud and delusion can hide in plain sight because everyone is making money. Then, look at the late 1960s and the tronics boom. It is almost laughable how perfectly history repeats itself. Back then, if a company simply added the suffix onyx to its name, its stock price would double overnight. It did not matter if they were selling shoelaces or vacuum tubes, if it sounded technical, the money poured in. Today, we see companies that used to sell iced tea or mining equipment suddenly pivoting to AI infrastructure or data center logistics because that is where the political wind is blowing. The administration's policies have encouraged the charade by offering tax credits and grants to anything labeled strategic tech. It is the tronics boom all over again, but with trillions of dollars instead of millions. It is what I call social proof gone wrong. Monkey see, monkey do. If the president says AI is the future, every CEO in America feels compelled to pretend they are an AI company to keep their stock price up. But perhaps the most damning parallel is the nifty 50 era of the 1970s. This is the one that really scares me when I look at your market in 2025. Back then, institutions convinced themselves that there were only about 50 stocks worth owning, companies like Xerox, Polaroid, and Avon. They were called one-decision stocks because the only decision you had to make was to buy them, you never had to sell. They traded at 50, 60, 80 times earnings. The logic was that these companies were so dominant, and the government environment so favorable to American corporate power, that they could grow to the sky. Well, they did not. The math eventually caught up with them. When the valuation compression happened, you lost 90% of your money in great companies. Today, you have your own Nifty 50, but it is more like the Nifty 5. The concentration of the entire market into a handful of AI winners, bolstered by the administration's protectionist tariffs that insulate them from foreign competition, is a recipe for a disaster of biblical proportions. And let us not forget 1999. I saw people quit their jobs to day trade internet stocks. We had the most pro-business narrative imaginable, asserting that the internet would eliminate the business cycle. We had Alan Greenspan effectively promising to bail out the market if things got tough. That is exactly what you have now with the perception of the Trump put. Investors believe that because the administration has staked its reputation on economic dominance through AI, they will print infinite money to keep the stock prices high. But in 1999, Cisco Systems was the most valuable company in the world. It made the routers that ran the internet. It was a real company with real profits. But at its peak valuation, it was priced to capture more profit than existed in the entire hardware industry. If you bought Cisco in 2000, you are still likely underwater in real terms today. The infrastructure builders of 2025, the chip foundries, the energy grid upgrades, are the Ciscos of today. They are great businesses priced for an impossible future. The pattern is always the same. First, there is a displacement, a new technology. Then, a boom fueled by credit and government cheerleading. Then, euphoria, where caution is mocked and skepticism is viewed as unpatriotic or Luddite. Finally, there is the panic. The Trump policies have essentially acted as an accelerant to the euphoria phase. By removing friction and promising endless support, they removed the natural fear that keeps markets healthy. When you take away the fear of loss, you get recklessness. We are seeing capital expenditures today that are completely untethered from demand, just like the fiber optic cables that were laid in the 90s and went dark for a decade. History shows us that whenever the government picks winners, the market eventually punishes the participants. The railroads in the 19th century were heavily subsidized by the government, and most of them went bankrupt. The early airline industry was propped up by mail contracts, and investors lost their shirts. Now, we have the government effectively subsidizing the AI build-out to beat China. This nationalism is a powerful drug, but it does not change the laws of return on invested capital. You are looking at a classic boom-bust cycle, amplified by a populist political agenda that equates stock market performance with national success. It is a tragedy of errors, and the ending has already been written in the history books of 1929, 1974, and 2000. The beautiful thing about arithmetic is that it does not care who the president is. It does not care about your political party, your hopes, your dreams, or your delusions. Arithmetic is the merciless judge of all investment decisions, and right now, the arithmetic of the artificial intelligence sector is screaming danger so loudly that it is deafening. Yet, because of the euphoria surrounding the administration's policies, everyone is wearing earplugs. Let us sit down and do what I call napkin math. You do not need a supercomputer or a team of analysts from Goldman Sachs to figure this out. You just need a pencil and a piece of paper. Let us look at the valuations of these so-called AI winners in the year 2025. We have companies trading at valuations that imply they will capture a percentage of global gross domestic product that is frankly hallucinogenic. Consider a typical darling of this market, let us call it Company X to avoid lawsuits, though we all know who the culprits are. This company is currently valued at roughly $3 trillion. Now, if you are a rational investor, which almost no one is these days, you should demand a return on your capital that exceeds the risk-free rate. With interest rates where they are, kept stubbornly high by the very inflation these pro-growth policies created, you should want at least a 10% return on your equity. That means this company needs to generate $300 billion in distinct, distributable cash flow every single year just to justify its current price. Note that I said distributable cash flow, not EBITDA. Every time I hear the word EBITDA, I reach for my wallet because someone is trying to steal from me. I am talking about real cash that can be paid to owners. But look at what these companies are actually doing. They are not distributing cash. They are engaging in the largest capital expenditure binge in the history of capitalism. They are spending hundreds of billions of dollars on graphic processing units, cooling systems, and nuclear power contracts. They are burning the furniture to heat the house. To justify the current stock price, Company X needs to grow its earnings at 20 or 30% a year for the next decade. Do the math on that. If a company with $200 billion in revenue grows at 30% for 10 years, it ends up being larger than the entire economy of the United States. It is a biological impossibility. Trees do not grow to the sky, and neither do corporations. Eventually, you run out of customers. The Trump administration's policies have distorted this math by creating artificial incentives. By offering accelerated depreciation on these massive server farms and protectionist tariffs that supposedly help domestic tech, they have encouraged companies to overinvest. It is a classic capital cycle mistake. When the government subsidizes capacity, you get overcapacity. We are building enough data centers to power a civilization 10 times our size, but the actual revenue coming from AI software, the subscriptions, the practical uses, is a tiny fraction of the cost of the infrastructure. Let us look at the price-to-sales ratios. We are seeing large-cap companies trading at 15 or 20 times sales. This is insanity. As my friend Scott McNealy said back in the dot-com era, at 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That implies zero cost of goods sold, zero expenses, zero taxes, and zero research and development. It is impossible. And yet, people are paying 20 times revenues today. Why? Because they believe the Trump AI boom will somehow suspend the rules of accounting. They argue that AI will replace labor, so margins will expand to infinity. This is a fallacy. In a competitive market, which the president claims to love, excess profits are competed away. If AI makes business cheaper, the prices of goods will fall, and the profit pool will shrink, not expand. Furthermore, look at the input costs. The tariffs on foreign components and the scarcity of energy are driving up the cost of doing business. You have a situation where the cost of goods is rising, but the market is pricing in perfect, friction-free growth. This is a fundamental disconnect. Investors are currently paying a premium for growth that is actually just spending. When a company announces it is buying $10 billion worth of chips, the stock goes up. That is backward. Spending money is easy, making money is hard. The market is celebrating the spending as if it were earnings. It is the equivalent of a shopkeeper celebrating because he bought 1,000 expensive cash registers, even though no customers have walked through the door yet. The math of the total addressable market is also fraudulent. The bulls claim the AI market will be worth tens of trillions. But who pays for it? The consumer is tapped out. Corporations are already drowning in debt. The government deficit is exploding. There's no magical source of liquidity to pay for these high-priced AI services. We are approaching a point where the return on invested capital for these AI clusters is going to turn negative. When that happens, the write-downs will be colossal. We are talking about hundreds of billions of dollars of equipment becoming obsolete overnight because a newer, faster chip came out, or simply because the electricity bill was too high. The irony of the Trump policies is that by trying to force-feed growth into the tech sector, they have destroyed the mechanism of price discovery. The prices you see on your screen are not real. They are the result of momentum algorithms and passive flows chasing a narrative. But the underlying cash flows, the actual pennies of profit, cannot support the weight of these valuations. You are buying a stream of future cash flows that does not exist. You are paying a Rolex price for a digital watch that is running out of batteries. It is simple, really. If you pay a high price for an asset, your future returns will be low. If you pay an astronomical price, your future returns will be disastrous. Right now, the market is priced for perfection in a world that is messy, inflationary, and constrained by physics. The numbers do not lie, but liars figure, and right now, the entire market is figuring that 2 + 2 = 47. It does not. And when the correction comes, it will simply be the return of arithmetic, taking its revenge on the mathematically illiterate. If I have learned one thing in 99 years of watching human behavior, it is that the human brain is not designed for the modern financial markets. It is designed to run away from lions on the savannah and to find the nearest source of easy calories. We are walking around with Paleolithic hardware trying to navigate a digital, high-frequency world, and the result is a disaster. The current mania surrounding the Trump AI policies is not a failure of economics, it is a failure of psychology. It is a textbook case of what I call the psychology of human misjudgment, playing out on a trillion-dollar scale. The most powerful force driving this bubble is not earnings growth or technological breakthroughs, it is social proof. This is the deep-seated, instinctual need to do what everyone else is doing because it feels safer to be part of the herd. When you see your neighbor, who you know is not as smart as you, making a fortune in these AI infrastructure stocks, it drives you crazy. As I have always said, it is not greed that drives the world, but envy. Envy is the stupidest of the 7 deadly sins because it is the only one you cannot have any fun at. And right now, the American public is consumed by envy. They see the headlines about the Trump tech boom, they see the charts going up and to the right, and they abandon all reason to chase the performance. The administration has masterfully weaponized authority bias. You have a president who positions himself as the ultimate dealmaker and a business genius. When he stands up and says that his deregulation policies will make these companies the most valuable on earth, a huge percentage of the population turns off their critical thinking faculties. They trust the authority figure. They conflate political loyalty with investment strategy. This is incredibly dangerous. Just because you like a politician's tax policy does not mean the stocks he likes are trading at a rational price. But the bias is so strong that people are treating their brokerage accounts like ballot boxes, voting with their dollars for a narrative rather than analyzing the underlying businesses. Then we have incentive-caused bias, which is the superpower of the financial industry. Wall Street is currently incentivized to sell you this story. The fund managers, the analysts, and the television pundits, they all get paid based on assets under management and trading volume. They cannot sell you caution. They cannot sell you cash. They have to sell you the next big thing. So, they draft off the president's rhetoric. They create patriotic AI ETFs and American dynamism funds. They know in their hearts that the valuations are absurd, but as long as the music is playing, they have to dance. As Lord Keynes said, worldly wisdom teaches that it is better for reputation to fail conventionally than to succeed unconventionally. An institutional investor would rather lose 30% of your money buying the same AI stocks everyone else owns than risk underperforming the S&P 500 by holding cash. They are trapped in a game of relative performance that guarantees absolute destruction. We are also witnessing a massive case of commitment and consistency bias. People have poured so much of their identity and their capital into this thesis, that Trump plus AI equals infinite wealth, that they cannot psychologically afford to change their minds. When the data starts to turn negative, as we are seeing now with the energy bottlenecks and the margin compression, they do not sell. They double down. They invent new reasons to justify their holding. They say, "Oh, this is just a pause," or "the president will fix the energy grid." They are like a man who has bet his house on a horse race. He cannot look at the horse objectively anymore. He is praying, not analyzing. This is exacerbated by deprival superreaction syndrome. Investors feel entitled to the gains they have seen on paper over the last year. If the market drops 10%, they react with irrational intensity, trying to win it back immediately. This leads to the break-even effect, where people take massive, foolish risks just to get back to where they were. The volatility we are seeing in 2025 is a symptom of this. It is a market composed of desperate addicts trying to hold on to a high that is fading. Let us not forget simple, pain-avoiding psychological denial. The reality, that we are in a late-stage bubble, that interest rates are hurting the economy, and that the AI payout is years away, is too painful to accept. So, the market creates a collective delusion. They ignore the warnings. They ignore the insider selling. Have you noticed that the CEOs of these magnificent AI companies are selling stock as fast as they can? That is the ultimate signal. They know the truth. But the retail investor, blinded by hero worship and the fear of missing out, ignores the signal. They think they are partners with these billionaires, but they are actually the exit liquidity. The Lollapalooza effect occurs when multiple biases converge to drive an outcome to an extreme. Right now, we have social proof plus authority bias plus envy plus denial all pushing in the same direction. It creates a feedback loop that disconnects price from reality entirely. The market becomes a measuring stick of sentiment, not value. And sentiment is fickle. It can change overnight. When the psychology shifts, when the fear of loss finally overpowers the fear of missing out, the collapse will be breathtaking. You must understand that the market is a voting machine in the short run and a weighing machine in the long run. Currently, the voting machine is being rigged by psychological biases and political cheerleading. But the weighing machine is ruthless. It does not care about your feelings. It does not care about the president's tweets. It only cares about cash flow. The psychological trap is believing that this time is different, that the laws of human nature have been suspended because we have faster computers. They haven't. The same greed that fueled the South Sea bubble is fueling the Trump AI trade. And the same panic that followed will follow this. Do not let your brain betray you. Recognize these biases. Step away from the herd. The view is much clearer when you are not standing in the middle of a stampede. The German mathematician Carl Jacobi had a simple trick for solving difficult problems: invert, always invert. He knew that many hard problems are best solved when they are addressed backward. Instead of asking, "How can I help my country?" ask, "How can I ruin my country?" and then avoid doing those things. So, let us apply this glorious mental model to your current obsession with the Trump AI trade. Instead of asking, "How much money will I make if the administration's deregulation sparks an AI utopia?" let us ask, "What has to happen for me to lose a significant portion of my capital?" First, consider the geopolitical ramifications of the protectionist policies currently in place. The administration believes that by slapping tariffs on foreign semiconductors and rare earth minerals, we are protecting American industry. But invert that. What if the retaliation from global trade partners chokes off the supply chain entirely? You have these trillion-dollar AI companies that are utterly dependent on a global supply web. If they cannot get the specific capacitors from Southeast Asia or the cooling components from Europe because of a trade war, their production lines stop. You are holding a stock priced for perfection in a world where the supply chain is being smashed with a sledgehammer. The downside risk here is not just a missed quarter, it is a structural inability to operate. Second, look at the energy equation. The bulls say, deregulation will allow us to build power plants faster. Invert it. What if the physics of the grid cannot handle the load, regardless of the regulations? We are already seeing brownouts. If these massive data centers start consuming 20% of the grid's capacity, and grandma's lights go out in Wisconsin, do you think the populist administration will side with the tech billionaires or the voters? They will cap the energy usage of data centers. They will tax the electricity. The regulatory moat you think you have is actually a regulatory noose. If the cost of electricity doubles, which is a distinct possibility given the inflationary pressures of these policies, the margins of the AI service providers evaporate. You are betting on cheap energy in an era of energy scarcity. That is a way to go broke. Now, let us talk about the most important concept in all of investing, one that is totally ignored in a mania: opportunity cost. Everything in life is a trade-off. When you buy a share of a hyped-up AI infrastructure company at 50 times earnings, you are not just buying that stock. You are explicitly rejecting every other use of that money. Look at what you are rejecting right now. It is criminal. You can currently go out and buy short-term U.S. Treasury bills yielding 5 or 6%, thanks to the inflation kept alive by the fiscal deficit. That is risk-free. That is a bird in the hand. But the speculators are spitting on that bird to chase a flock of imaginary birds in the bush. They are accepting a dividend yield of 0.5% from tech stocks, hoping for capital appreciation, while turning down a guaranteed 6%. This means that equity risk premium, the extra return you should get for taking the risk of owning stocks, is effectively negative. You are paying for the privilege of taking risk. That is not investing, that is masochism. Furthermore, look at the boring businesses that are being left for dead. I like businesses that are easy to understand. I like businesses with a moat. While everyone is chasing the next neural network, you can buy wonderful agricultural companies, energy producers, and insurance firms at single-digit price-to-earnings ratios. These companies actually benefit from the inflation that the AI boom is causing. If energy prices go up, the oil producer makes more money, while the AI company sees its costs rise. By ignoring these old economy stocks, you are missing out on the only sector that has a margin of safety. We hold a lot of cash at Berkshire. People always criticize us. They say, "Charlie, Warren, you are out of touch. Why aren't you buying the dip?" They do not understand the value of optionality. Cash is not just a pile of paper, it is a call option with no expiration date on every asset class in the world. When the bubble bursts, and it will, cash becomes the most valuable asset on the planet. It allows you to buy dollar bills for 50 cents. By being fully invested in this Trump AI narrative right now, you are stripping yourself of the ability to act when the real opportunities arise. You are fully committed to a burning building with no exit strategy. Let's invert the productivity miracle thesis. The argument is that AI will replace workers and boost profits. But what if it just commoditizes intelligence? If everyone has a super genius AI assistant, then no one has an advantage. It becomes table stakes. The price of intelligence drops to zero. If you are a software company and your code can be written by a free bot, your pricing power is gone. So, the trillions of dollars spent on these models might result in a product that has to be given away for free to compete. You are investing in a deflationary technology at an inflationary valuation. It creates a Red Queen effect where companies have to run faster and faster just to stay in the same place. The opportunity cost of following the herd is your peace of mind and your financial independence. You are trading sleep for anxiety. You are glued to the ticker, wondering if a tweet from the White House is going to tank your portfolio. If you own a farm, or a local apartment building, or a boring manufacturer of ketchup, you wouldn't care. You would just cash the checks. The Trump AI trade requires you to be smarter than the market every single day. The value trade only requires you to be patient. The smartest people I know are not buying Nvidia or its cousins right now. They are sitting on their hands. They are reading books. They are buying short-term bonds. They are waiting for the fat pitch. In baseball, you don't have to swing at every ball. You can stand there with the bat on your shoulder for 3 innings, and the umpire can't call you out. But the market seduces you into thinking you have to swing. You don't. The cost of waiting is paid for by the interest on your cash. The cost of swinging and missing is ruin. So, invert the situation. Assume the pro-AI policies fail. Assume the grid breaks. Assume the valuation multiple contracts from 40 to 15. If that happens, can you survive? If the answer is no, then you have no business being in this market. You are picking up pennies in front of a steamroller, and the steamroller has a Make America Great Again sticker on it. It will crush you just the same. We have walked through the valley of the shadow of debt. We have looked at the distorted history, the impossible mathematics, the psychological delusions, and the terrifying opportunity costs of this Trump AI era. Now, it is time for the verdict. You came here asking if the president's policies have backfired. The answer is an unequivocal yes, but not in the way the pundits on cable news will tell you. They didn't backfire because they failed to stimulate activity, they backfired because they stimulated the wrong kind of activity. They poured gasoline on a speculative fire rather than building a foundation for sustainable growth. They created a casino where a factory used to be. So, what should you, the individual investor, do in the face of this madness? My advice is simple, though it is not easy. It requires a temperament that most of you do not possess, but which you must cultivate if you want to keep your money. Get out of the casino. If you are holding these high-flying, government-subsidized AI infrastructure stocks that are trading at 80 times earnings, sell them. I am not saying you should short them, never short a bubble, because irrationality can last longer than your solvency. I am saying you should take your chips off the table. You have been given a gift by the market, a price that is disconnected from reality. Accept the gift, sell the stock, and pay your taxes. Do not let the fear of taxes prevent you from booking a profit. As I have always said, I have never let tax considerations determine a major investment decision. It is better to pay the IRS 20% of a profit than to lose 50% of your principal when the bubble bursts. Take that capital and move it to safety. In this environment, safety means short-term U.S. Treasuries and high-quality, cash-generative businesses that have been left behind. I am talking about companies with strong balance sheets, pricing power, and products that people need regardless of whether an AI chatbot can write a sonnet. Look for the cannibals, companies that are eating themselves by buying back their own stock at cheap valuations. That is where the real value is in 2025. You must understand that cash is not trash. In a bubble, cash is oxygen. Right now, holding cash feels painful because everyone else seems to be getting rich. But when the correction comes, and it will come with the violence of a coiled spring releasing, cash will allow you to act like a predator while everyone else is acting like prey. You want to be the one providing liquidity when the market is desperate for it, not the one begging for it. Do not listen to the siren song of the new paradigm. Every few years, some politician or some tech guru claims that we have conquered the business cycle. It is always a lie. The business cycle is driven by human nature, and human nature does not change. We swing from fear to greed and back again. Right now, we are at the peak of greed, fueled by the illusion of political support. The Trump put is a mirage. When the inflation numbers get ugly enough, the administration will have to choose between saving the stock market and saving the currency. They will choose the currency, or the bond market will choose it for them. And when that happens, the liquidity that is propping up your AI stocks will vanish. You need to cultivate the art of sitting on your ass. That is a technical term. You do not make money when you buy, and you do not make money when you sell. You make money when you wait. The big money is not in the frequent trading, it is in the waiting. Wait for the fat pitch. It might take a year. It might take 2 years. But the market will eventually offer you wonderful businesses at fair prices. Right now, it is offering you speculative junk at wonderful prices. Reject the offer. Stop trying to be smart. Trying to be smart is how you get into trouble. Just try not to be stupid. Buying a cyclical hardware company at the top of a capital expenditure cycle because a politician gave a speech is stupid. Avoiding that mistake puts you ahead of 90% of professional money managers. You do not need a high IQ to succeed in this game. You need character. You need the discipline to stand apart from the crowd and say, "This makes no sense, and I will not participate." The policies of the last few years have created a distortion field. They have made gambling look like investing. They have made prudence look like cowardice. Do not be fooled. The hangover from this party is going to be severe. We are looking at a period of lower returns, higher volatility, and likely stagflation. The only way to navigate this is with a fortress balance sheet and a mindset of extreme caution. Build your circle of competence and stay inside it. If you do not understand exactly how an AI company will monetize its billions in server spend, do not buy it. If you cannot explain the valuation on the back of an envelope, do not buy it. Stick to what you know. If you know nothing, buy an index fund of the entire market, but only when the valuation of the market as a whole makes sense, which right now, it emphatically does not. My final word to you is this: rationality is a moral duty. You have a duty to yourself and your family to protect your capital from the madness of crowds. Do not let the fear of missing out turn you into a fool. The market will be here in 10 years. The AI revolution, whatever it turns out to be, will play out over decades. You do not need to catch the first wave. The pioneers usually get the arrows in their backs, the settlers get the land. Be a settler. Be patient. Be rational. And for God's sake, stop looking at the ticker every 5 minutes. Go read a biography of Benjamin Franklin. It will do you more good than watching another press conference about deregulation. I have nothing more to add.